but what the what the Fed has done as of late, and all other central banks, I am very bullish gold at these levels. Now, it doesn't mean that I'm going to be feeling the same way if we breach new highs, but I do think that gold has the ability at this point, especially with this very long-term base that we've developed, to at least test the highs, if not break out eventually. I think it's a safe haven for a lot of people in this current environment. Now, looking at gold and where we can go near term, I think gold trades up to 17, 70, maybe as high as 1850 before we see some sort of, material pullback. But, the gold market does look very bullish. I can let Stelios talk all day about silver, but silver, is trying to play some catch up. A lot of people think that, the silver gold ratio is going to flip and we're going to start to see silver outperform gold, which is possible. What is that you? You know what? I'm sorry. I have two different calls going right now. I have a call going with my office, and then I have a call. This call going. So every once in a while, I hear these sounds, and I'm not sure if it's Steve or Stelios or somebody from the office.
No, mate, we're muted. We are muted.
Okay, all right. So anyway, but silver, like I said, the a lot of people speculate the gold silver ratio is going to flip. I'm not 100% sure I'm in that camp, but we'll see what gold or silver does here. It still looks relatively bullish. It's definitely lagging the gold market. Let's take a look at some of the major currencies like the euro dollar. So I said this in the daily roundup webinar, and I'm going to say it here because if you guys missed that yesterday, this is still possible. But, and I'm going to give you the buts, it's still possible as long as this trend line's holding right here. We start breaking below yesterday's lows, it comes in around 108.50. Then I think you have to be a little skeptical about the potential of the euro dollar. Now, one of the reasons why, the dollar strengthened yesterday, why the euro fell, is because of the risk off, if you will, mode of the market. Okay, that risk off mode really, put a damper on anybody who was bearish the dollar. So I don't have any euro dollar exposure, although I know a lot of our traders in our chat room were trading off this trend line yesterday. Notice how we just revisited those lows. So I think that today it's going to be very important, that we hold this support. If we don't hold this support, the risk of a euro sell-off or more dollar strength, I think, is quite high. Now, that's not necessarily the chart that I'm paying really close attention to today. I'm really paying very close attention to the Aussie. Now, let me show you why. So the Aussie, you notice this uptrend line, right? We have broken that uptrend line and we're consolidating below it. So what's going to be very important to me is that we hold these lows, and if we break through the overnight lows, which comes in around, you could say 62.70 ish, that's going to be a fairly bearish event for the Aussie dollar. So I am keeping a very close eye on the Aussie here, because I think what comes with Aussie dollar weakness is going to be equity market weakness too. I'm sitting here looking at the S&Ps, and as you guys know, while we're below this 2,900 level, I think the risk is that we pull back. This is a really key uptrend line. This is our ascending channel support. So this low right here is going to be very important, like this 2,700 roughly. Okay. A break below 2,700 should take us back down towards 2,500. Personally, I personally think in the equity markets, we're going to be consolidating here, something around these levels. So, We overshot to the, we overshot to the downside. We overshot to the upside. We're probably going to be in, like a consolidation that looks more like this, maybe between, 2,500 and 2,700 for, the next few months while the market, really takes in what's happening with the virus and how it's affecting the global economy, especially as we go into the fall. And I think that the move out of this consolidation area, this after, I'm assuming this summer we're going to be just kind of bouncing around here, but the move out of this consolidation that we build will be probably based more on, do we get a, do we get a vaccine, for the coronavirus? Is it effective? Do people go back to work? Do we have a second wave? So I think the easy money on the downside in equities have been made. The easy side, or the easy money on the upside has been made in equities, and now it's going to be more of a challenging type of situation. And if you're looking at the S&P the way it looks right now, let me delete that. This to me, right, looks more like a head and shoulder pattern currently. So I think you gotta, kind of be careful with longs up here. And like I said, the some of the things that are going to cue me into, thinking that the stock market's ready to roll over again is looking at currencies like, the Aussie dollar, seeing how the dollar is responding here. The dollar does look strong against, certain currencies, especially like if you're talking about the dollar Canadian, or if you're talking about the Aussie. And let's go take a look at the dollar Canadian, um, and just kind of look at like the basic technical analysis that we've been following the last few days. If you go back, a couple of days ago, we this analysis right here on the 14th, this happened to be our chart of the day too. So if you're not a Forex Analytics subscriber, you can go to the blogs and you can, see the charts of the day. So this chart specifically was setting you up for the bullish, pennant setup. All right. And if you, let's go back to, then if you want to follow the analysis going through that, you know, we talked about really the key resistance, okay, um, uh, of the currency pair breaking above the 140 level, 139, the 139.25, and now that it's broken out, the dollar Canadian is at risk of trading a lot higher. And a lot of this is going to be predicated on, how stocks act from here. But I'm going to tell you this much: I have bids in the dollar Canadian lower that have not gotten filled, and you know that worries me, because that means that I'm probably going to have to chase this currency pair higher at some point, because I'm not getting my fills down here where I was hoping it would go. And what it seems like to me is the dollar Canadian is consolidating, waiting for its next leg higher. And if you look at this technically, depending on how low we can drop, the extension of what we see here takes us all the way to like 143, 143.50, from just a new bullish pennant inside a longer term pennant that actually points a lot higher than we're currently at. But I'm looking at the dollar Canadian, keeping a very close eye on it, because I do think it's very bullish, and it has the potential to move a lot higher. There's a lot of things working against Canada right now, and one of the big key components there is crude oil trading where it's at, and if crude starts trading back below 20, and more importantly back below 19, that is going to single-handedly, in my opinion, put the dollar Canadian back up in the mid 40s. Um, so anyway, that's just something I wanted to mention. So somebody asked, what is this platform? This is the Forex Analytics platform right here. So this is Forex Analytics, and if you it's our company. We're the ones that put on this webinar. If you want to learn more about Forex Analytics, here it is. And you can watch a video on what we do, and then there's a mobile app, and you can see the pricing, and you can also try it out for $1 for 10 days. So anyway, and you have to imagine all this information that you see here, whether it's the live stream calendar, integrated Twitter, money management, risk management tools, the different analysis between harmonic analysis, Elliott wave, basic technical, candlestick, macro analysis. It's all available to you not only on your desktop, but also on your mobile phone. Plus we have, chat rooms. Our chat rooms are probably the, one of the things that if you're active in the market, it's probably our most valuable tool, because that's where all of us are at all day long. This is our chat room here. There is currently 104 of us in this chat room right now. So, and you guys are on Jumbotron. You can see we chat all day. I'm in here literally all day. Well, like 12, 15 hours. You can see we post charts, like Thomas posted that on the Canadian. Amanda is posting that on the Euro Aussie. By the way, I love that this inverted head and shoulder pattern of the Euro Aussie. I 100% agree with this chart. Amanda, just so you know, she's listening in right now. There's Benedict, Nidish, Amanda, there's Olivier, Dominic, DK, that's Dom, Stelios. So, and everybody's listening in here too, and they know they're on Jumbotron. So there's Jane in Spain. Did that come out correct? Did that come out right? Anyway, all right. So that's what Forex Analytics is in a nutshell. So hope you become part of our community. All right. So with all that being said, I know Stelios is here. Good morning, Stelios.
Good morning, Sir Blake.
How you doing?
I'm very well.
How's it? Is it warming up there in Athens?
Oh yeah, it's getting better. It's sunny. It's warm, and we seem to be handling things well here. I mean, I was just reading. We had 21 new cases here, and in total, we've had like 100 deaths. So I'm actually amazed that Greeks were disciplined enough to contain this. So we are here, day 43 of lockdown, but who's counting? And things are good.
You know what I was thinking is maybe you should bring back Cyprus.
Cyprus, no, don't ever say that.
Thank you. I'd rather stay in a lockdown for another couple of months.
So you know what's really interesting about your prime minister is he obviously stays under the radar, but he's doing a really good job with you guys there. So
yes, and he's a really welcome change from the recent stuff that we've had. So yeah, we're very happy with that.
And by the way, a product of your educational system, Harvard.
Oh, is he a Harvard grad?
Yep.
Yeah.
Well.
So yeah.
So what's going on today? What are you guys? It's been a quiet day in the FX market. Like I said, I've got my eyes on gold. I'm watching the Aussie. I think the S&P is going to turn lower as we head into a range going into the summer. Remember, we are in getting close to sell in May, go away anyway. So seasonal problematic times for the equity markets anyway. And then you compound that with everything that the world is dealing with. I think the market is a little optimistic here as far as equities go, because I do think that you just listen to Prime Minister Abe this morning extending lockdowns. Merkel in Germany is extending lockdowns. In the United States, as much as Donald Trump doesn't want to extend lockdowns, there are certain parts of the United States that are going to stay locked down for quite some time, I think. And the toll that when you close down the global economy for months on end, there is a financial toll that will be taken. And I know the stock market is not the economy, but I do think that stocks will be negatively affected. So
Yeah, I agree. I agree.
when you look when you look at the S&P, you look, obviously the Nasdaq's doing well or better, and everybody should know the reasons why. You got big hitters like Netflix and Amazon that are actually thriving in this environment. But you look at the Dow. The Dow's only uh, you know taken back 50% of its move, and the S&P has only taken back 50% of its move, just a little bit more, where the Nasdaq's obviously done a little bit better. But you know like I said, we overshoot to the upside, we overshoot to the we overshoot to the downside, we may have overshot to the upside, which leaves us in a situation where we're probably going to consolidate at a little bit lower levels than where we're currently at. So what are you guys' thoughts here?
Well, I've said it before. I think the effect on the economy is going to be bigger than people anticipate. I think V-shaped recovery is out of the question. And if you look at, everybody's been talking about the Italians, right, in terms of the number of infections and deaths. And look at Spain and France; they're only marginally behind Italy. And Europe in general, I think they, some of the countries, the UK is also, in full swing now, and Belgium, I think the virus will come and go, but the effects are going to stay. And I've said this before. I think we have one more leg down. And like you mentioned, sell in May and go away. That the seasonal aspect is coming into play as well. And I wouldn't be surprised if the S&P is quite a bit lower in the next month or two, and DAX as well. But having said all that, I'm looking for this last leg lower to start buying. That's my
guys. I forgot to comment on that yesterday. Did you see the estimate for U.S. deficit that came out 2 days ago?
Is
It's
it in
World
the
War II levels, right?
quadrillions? No.
Keeping in mind that last year's deficit was close to 800 billion, but that's a lot lower than the actual deficit, because we've talked about in the past that there are a lot of off-budget items. Now, don't ask me why it works like that. We can all give that answer, because the 800 official budget deficit translated to a need to borrow by 1.4 trillion, which is the actual deficit. Now, I had to say that in advance so you can put the number I'm going to give you in context. Now, the estimation for the official one for this year, without counting the off-budget items, is 3.8 trillion.
Jesus Christ.
Peanuts.
That's incredible, yeah.
Peanuts. So real quick, I'm bringing up this chart of the US dollar Japanese yen. We had a pretty epic failure overnight at 108. Unfortunately, I wasn't around to take advantage of that. But if you're using Forex Analytics and you're reading the analysis like from overnight, let's see, the overnight analysis would be end of day with the 107 level support holding. The risk of a 107 to 108 range overnight seems likely. This is last night's end of day analysis. If you were trading the dollar yen in Asia last night or in European trade, we failed at 108.08 was our high, and we're rolling back over. What are your thoughts here, guys, with the yen? I think that the yen is at risk of a continued move higher. It's at risk of a continued move higher, meaning that the yen pairs will fall, especially if equities, start to correct. I think this is a risk for the market. What are you guys' thoughts here? Ooh, what's up with the Aussie?
I agree, and I think the sign of strength that the yen has shown is that on this big and quick bear market rally that we had, it didn't really move that much. And to me, that shows strength. And the same with gold. gold didn't really drop as equities, rallied 20% or whatever it was from the lows of 15. What was it? I can't remember. So,
guys, I think there is an alternative interpretation. I think that the USD yen is simply more or less pegged. So I'm not sure if this is a sign of yen weakness or USD yen strength. It might as well, in my opinion, be a sign that, since the last few months, this pair has literally been pegged in a range. So I think until proven otherwise, we'd rather, trade and devote our capital and thought process in trading other stuff. That's what I think, at least.
Got it. All right. Well, hold on. The news that has come out is Mnuchin says Democrats are far apart after talks. There's a person familiar with so I think that's what's hitting the dollar right now. One of the reasons why the dollar has come under a little bit of pressure. You see the euro just lifted a little bit. The cable just lifted too. And remember, we're getting a little bit of jitters too ahead of the numbers, the employment numbers that are coming out here in just a few minutes. And they're going to be out actually in about 5 minutes. So we should probably keep a really close eye here on the dollar yen. Somebody asked me for
around 5 million.
Right? Somebody asked me for my email. My email is bmorrow@forexanalytics.com. So just if you are curious what my email is, bmorrow@forexanalytics with an x.com. Feel free to email me.
Also, we have a couple of people asking. You can find these webinars recorded in our website, forexanalytics.com. They usually posted a few hours after the webinar is ended. And somebody was asking about taking a trial. You can take a trial of our product. We offer two products, the light version and the premium version. If you take a 10-day trial, you will have access to everything. It costs $1. You have access to everything. So even if you choose the light version, so it's well worth doing if you want to sample our services.
So here's this data flash is actually included with Forex Analytics, and man, the dollar's really come under pressure here. Look at the dollar yen just breaking lower. I'm gonna, for those of you that don't have a Bloomberg system on your computer, I mean, look, it's not cheap. I pay $2,800 out of my pocket every month to get Bloomberg. All right, so not everybody's gonna have Bloomberg, but this is a data flash, and data flash is you'd be surprised how quick the data comes out here. It's a lot of times it matches. It's almost as fast as Bloomberg releasing information. So we'll be watching both as the data comes out. And there we go. Okay, here we're going to be looking at this number specifically, and obviously you can look at this number right here and this number right here. Okay, and then this is the dollar yen and a 5-minute chart. So this way we have this all running at the same time. So guys, did you have any comments that you wanted to say before this data is released?
Go
ahead, Celia.
No, I was just going to say, we have to remember the last three numbers that came out were all worse than expected. Just something to think about. And given the extent of the lockdowns and what's been happening, I really wouldn't be surprised if it's a higher number than 5.1 or whatever we're expecting.
To be honest, even if it's 5.1, if we assume that it's 5.1, with that we will have surpassed 20 million jobs lost in the span of 4 weeks. Just put that in context. I mean, it's unbelievable.
The worst week in 2008, 2009 was 800 something, right? So this is quite a lot bigger.
Yeah,
anyway,
I mean,
right.
Yeah.
All right, guys. Well, we have, let's see, we're about 30 seconds away from the data. Once this data comes out, I'm going to be passing it over to my colleague, Steven Stelios. They can take over for a little bit. Just remember, if you guys are missing Dale Pinkert, who's normally our host, his internet's down, and this is the second time in a couple of weeks, and it's understandable. A lot of our internet
in the United States, a lot of time is like third world country, but in certain places, he lives in Southern California, but it's just, there's very much taxed because so many people are working from home. So they probably are doing some sort of servicing in his area. All right, guys.
Okay.
Here comes the
There
data.
we go.
All right.
5.2 million, 5.25 million.
Good estimate.
Dollars firming up a little bit, just a little bit. So, it came in better than the Bloomberg estimates, but you guys can see all the data that came in so quickly. Housing starts obviously a little worse than expected. No, stocks are really enjoying this, though. Stocks are enjoying the number. They, obviously the stock market doesn't see it as being too big of a problem here.
Yeah, companies are going to be making money by aliens buying stuff, I'm assuming, since people are unemployed. What else can I assume?
Right. Okay, well, let's see here. Anything else? I guess the dollar yen's just kind of sitting here. Equity's got a little bit of a bump, and yeah, here we go. S&P's pushed up a little bit, and I'm going to pass it over to you guys. So, everybody, thanks for being here with me. Steve and Stelios are going to take over here. Remember, they're going to talk about the Traders Summit. Steve is going to pull up a link. We have a huge. First of all, I gotta give a hats off to our team putting together the list of people that are coming. Steve, can you flash all of our speakers that are coming? And this isn't, guys, and it's free.
There we are. Peter Schiff, Mark Chandler, Mark Yusko, Peter Bukvar, Peter Goodburn, Mark Newton, Adam Batten, Lydia Finkley, Boris Schlossberg, this guy Blake Moore, I'm not sure who he is. James Sadley and Stephen Marcantonio. Most know him as Steve Anton.
Huge list of people. Obviously, Stelios's man crush of Peter Schiff is going to be on, but I'm friends with a lot of these guys, and I mean, we got some really heavy hitters that are going to be here, and it's not, everybody's going to have a basically a 45 minute window to talk and present, and you guys are going to be able to ask questions. It's going to be an awesome event. So it is co-hosted with us with IG Bank. So
here are our sponsors.
Yep. And and Forest Park, who's our webinar sponsor, and the CMT Association, which Joe Perry from our team is a CMT. So
I'm on the way as well.
What's that?
I'm on the way as well.
Oh yeah, yes. Steve is on the way too. So you guys make sure that you sign up for that. Steve, are you going to put in the link for people to sign up?
I've already put it a few minutes ago.
I will put it again.
And put it again. Use the one I used above with the specific reference.
Great. All right, guys. Hey, have a great one. Thanks everybody for tuning in with me, but don't leave because Steve and Stelios are going to take you through the rest of the market. So have a good one. I'll see you on the daily roundup webinar. Those of you that are Forex Analytics subscribers, I'll see you in 4 hours.
Bye-bye, Blaker. So
bye, guys.
a little bit less than 13 days left. Needless to say that 7 of these people are regular, making regular appearances on, Bloomberg TV, CNBC, etc. And they're people that, we don't choose people based on their popularity, but also based on, how consistent they are with their ideas and how frank they are with the audience. Because we don't want people that will just, tell investors what they want to hear. We want people that actually have a very good understanding of the economy and the financial markets, because all of those people that you see here are not just theoretical people. Of course, we have a lot of traders, that, but we also have, Mark Yusko is in charge of a fund that's like 2 billion. Everybody knows Peter Schiff. Mark Chandler has written several books.
It's a great lineup. It's
an amazing lineup. Really, you shouldn't miss this event. We did the utmost to collect, the best of the best people, and we are more than honored that actually every single one of them accepted our invitation.
Excellent. People are already registering. Nice. Yeah. So, so that's coming up in a couple of weeks or less than 2 weeks. What else is there to mention today? Like Blake said, it's been a quiet morning. The numbers came in line. Not much is happening in the markets. Equities like them, although I do think this is a dead cat bounce. I've said it before. I think we're going lower. Don't get me wrong. I think equities are going to make new all-time highs. When is it going to be? I don't know, but they're going to make new all-time highs, and I'm looking for levels lower to start buying. S&P, I was saying originally 1,800 to 2,000. We might not get there, so anywhere between 2,000 to 2,200, I'm going to start buying. And DAX, I think, is going to be testing the previous lows at around what were they, 8,000 and a bit. And I'm definitely going to be buying there.
Yeah, DAX bottomed at 7,968 on my chart. So yeah, you were right, roughly 8,000 still.
Yes, and the talk of the day again is in the US. There's a struggle between Donald Trump, who wants to open up the country basically, and there are many state governors who don't, and they're more skeptical about what's going to happen. And Trump, I understand he's thinking, he wants to get the market working again because this is really hurting. But the question is, what bigger risk do you take? At which point do you open it up? You can't wait for 0 cases, of course, but at which point do you say, I'm opening it up, and given the right precautions, it should be okay. Well, it might be a little bit early, but there is this battle between the president and some of the governors.
And by the way, we do understand the urge of wanting to open the economy because undeniably, there is a huge damage being made to the economy. But as practice already proved, the countries that began by trying to follow the herd immunity tactic actually ended up having to reverse course because they saw that.
Yes, and then you're late. You're late doing it, so the effect is worse, etc., etc. Yeah.
Yes, exactly. So probably they're going to have to come up with something else, perhaps keeping in a more prolonged isolation the sensitive parts and groups of the population. Because as an economist, I do acknowledge there is like a huge problem with the global economy almost being shut down. But on the other hand, human lives are what matters most. So there has to be found a proper balance between the two, because keep in mind that going in a depression will have direct costs in human lives as well, through other means. I mean, when a country doesn't have money, for example, to buy expensive cancer meds, people might not be dying, let's say, from coronavirus, but, isn't it the same if they keep dying from other diseases because there's not money to treat them?
Yes, true. And our friend Ingbar is saying it's a remarkable dip this week in New York Empire State and Philly Fed manufacturing surveys. Yes, I mean, they're showing a complete shutdown of the economy, or near complete shutdown, and that's
and keep in mind that we are now actually approaching the phase that 1 month backward looking data will start fully depicting the effect of the shutdown. So keep in mind that until now, some of the data we had, due to being backward looking, were showing us a period which was not fully affected by lockdowns.
Yeah, I think the numbers that are gonna, if best case scenario, the numbers are gonna start improving in May onwards, because you have to get through April, and hopefully they will be.
May probably the best case scenario still. I would say probably June onwards, but it might be end of May. So we have pain ahead of us. There's no question about it. I mean, this is not something that's going to be resolved overnight just by hoping and wishing. The Fed is going to buy ETFs. What does it mean? It doesn't really matter. The Fed is buying everything. The Fed has made 10 different special purpose vehicles to, in essence, nationalize the vast majority of the credit markets and indirectly make sure that those that keep bidding the markets stay solvent to keep bidding the markets. And now I'm talking about the stock markets. So, that's already more or less a given. And if they need to end up doing more, to artificially keep the stock market completely decoupled from the economic reality, they will. Now, the question, the million-dollar question here is, how successful will they be in that? In my opinion, they will be more successful than they would wish for, because keep in mind, there are two ways a stock market index can be going up. One of them, because of all the good reasons. Second of them, just because of inflation, right? Asset price inflation. And that's not a good reason for something to be going up. So I think they will succeed in that. The question is, what are going to be the real values of whatever is included there? Keep in mind also that if you look at the breadth of the market, you'll notice that you see, for example, S&P having recovered, quite healthily, more than 50% at the peak. But if you then start looking deeper in the market and realize that just 5 S&P blue chip stocks are weighted almost 20% for the index, and the fact that just a few selective stocks have actually kept the index high and kept this rebound going, and you see that the vast majority of the stocks that really show the underlying economy are still doing horribly, you'll understand that having a look just at the index doesn't give you a complete picture of what's really happening. Okay. With the flight to safety, USD strengthens, but with all the money printing and interest rate drops, surely there should be a lot of pressure on USD. That is correct. There will be a lag between changing from status A, what you meant, flight to safety plus some dollar demand issues, and the second part, which is the dollar is going to come under a lot of pressure due to the monetary policy being followed. So I agree with both your points, but those will not happen. One of them is happening now, but the other one is not going to happen immediately. It might take a few weeks to a few months, worst case scenario. But yeah, that's the next step. The next step when things settle down is for the dollar to really, really start moving lower, because there is not much of an alternative given, the path followed by the Fed. The Fed has offered to buy my baseball card collection, says Ziggy. Ziggy, you shouldn't be laughing about it, because one day soon, somebody might actually knock on your door from the Fed and ask if you do have a baseball card collection. So you'd rather be ready, mate. Let me go through some of your questions. So yesterday we stressed out the importance of seeing what's going to happen, because we started seeing the possibility of a reversal in stocks. The day didn't end up being that negative. It was a negative day, but not that much of a negative day. We also showed some FX charts that were pointing to a reversal. Blake already showed the Aussie USD that turned lower, but is still holding the channel. Look at the Kiwi. Kiwi formed a pennant, which it seems to have broken down below. So perhaps this divergence, perhaps Kiwi is leading Aussie in this case. Look at Aussie Yen. Another pennant here, barely holding support as we speak. Look at Kiwi Yen. Another pennant, also exactly at support. Look at RSI. RSI is also testing support. So bottom line, my point here is that there are a lot of FX pairs and a lot of instruments in general in the financial markets. Look at the USD CAD that has broken higher. Look at the USD MXN, which is a very nice proxy for risk. There it is, which also turned higher again. So, there are a lot of signs out there that we might be about to see a bearish reversal for risk, and whatever correlated asset will have to follow suit within likely this week. So I think it's going to prove to be an important week. Now, risk hasn't broken down yet. There was a friend yesterday after I made my introduction and I said that, listen, it seems that we might be reversing from here. He asked me if I'm still long the S&P, and I said, yes, I am, because, an intraday reversal doesn't tell me much. I want to see a real reversal signal. And as you see, so far, we don't have that. Yeah, yesterday was a negative day, but in essence, what yesterday did was erase most of the gains we had the day before yesterday. So all in all, nothing that registers as a really bearish reversal, right? But I do think that we're getting very close because the current valuations are absurd. Keep in mind that valuations up there at the all-time highs were a lot better than valuations here. And the reason is very, very simple. Because the estimation for earnings between then and today have really taken a dive, a huge dive, which means that the price to earnings ratio, the denominator has decreased the price, but earnings denominator has decreased even more. Okay, so we still have excessively high valuations, and you have to keep that in mind. So the path of least resistance, despite all the monetary stimulus coming in from the Fed, we assess, because as you heard, my partners and all the people working in Forex analytics, share this as a common understanding. I mean, each one from their different perspective, but most of us also believe that, we're not done moving lower. Now, it's one thing if we're going to see a lower low. I still think that it's a very high probability scenario. But in any case, I think that we should at least come close or revisit the lows. And I think that's going to happen when the market participants stop focusing that much on possible improvement in the coronavirus front and realize that no matter how fast we recover from that, the damage to the real economy has already been done. And it's not something we can get out of like, within a month or a couple of months. For every $1,200 stimulus, $16,000 was spent on buying private debt from US businesses. Yeah, absolutely. Because the vast majority of the US businesses were, in essence, insolvent. There were a lot of zombie businesses, thanks to the Fed and what they did during the previous two downturns of the economy, that could only stay afloat as long as we were in an environment that was not recessionary and as long as rates stayed at zero. So every single company that didn't tick those boxes, which they were a lot, once the economy would enter a recession, they would need bailing out. That was a given. And that all is due to the moral hazard that was introduced in the system mostly during the previous recession, during the financial crisis of 2008, but also in 2000. Great example of that is airline companies. 96% of the free cash flow that they generated during the past 10 years went into buying back their stocks at expensive prices. And guess what? Now they need a bailout. Why did they not care to have a safety cushion for a rainy day? Because they knew that the safety cushion for a rainy day is called the government, the taxpayer, and the Federal Reserve, the printing press. That's why. Because if they were left to actually go bankrupt during the previous recession, then the restructured companies would not be buying back their stock in excessive valuations. They would actually be building, some barriers, some safety funds in case something happened, which always there is something happening every few years, so they can stay afloat, right? Now, questions about metals. Listen, the situation about the metals is, quite simple. Gold remains at 7-year highs against the dollar, but only against the dollar, because against the vast majority of the rest of the currencies, it's at all-time highs. So keep that in mind, that the dollar is in a bull market and at all-time highs against the vast majority of the currencies. The breakout area clearly here was, roughly 1700, and as long as we stay above it, there's absolutely no reason to keep looking lower, right? So, you have to remain bullish until proven otherwise. Silver, not that constructive looking, and I have to respect the fact that $16 is a key confluence of resistances. So, buying it against $16 doesn't seem that smart of a tactic to me. I think we might get initially rejected there, and we might get a pullback in gold as well. When can this happen? Probably when stocks are going to be selling off again. So I have to say that in the short term, I would be very cautious gold here, but my medium to long-term thesis is undeniably bullish. Okay, so short term, I don't think these are very good prices to be buying. But I think that any real pullback in these metals, that especially gold, I mean, it's mostly monetary metal, are buying opportunities looking at a long-term horizon. Okay. Now, let me go. Question: if you like gold for this economic environment, why not Bitcoin? Because of roughly 620 reasons, but I will stick with 3 of them. One, gold has a history of 5,000 years. That's not an exaggeration. That's more or less the number. Bitcoin has never gone through a recession. This is going to be the first one. And the only data we have about Bitcoin and what it does in comparison to risk assets is the fact that when indices were doing this, Bitcoin was doing the same, but at a bigger percentage. So why not Bitcoin? Simply because it has no track record, and the very, very little track record it has, it definitely hasn't showed me anything that would make me think that it is a hedge in bad times. Also, Bitcoin has 0 intrinsic value. If tomorrow they decide that Bitcoin is for A, B, C, D reasons, doesn't matter what, illegal, worthless, they switch to a different technology, they replace it with something better, you name a billion different reasons, Bitcoin goes back to 0. If alternatively tomorrow they decide that for some reason you can't transact in gold anymore in any direct or indirect way, you will still be able to use gold to make jewelry. You will still be able to use gold in transistors. You will still be able to use gold in several industries. So gold, by definition, has intrinsic value. Gold will never and can never go to 0 because it's an actual commodity with actual usages outside of its monetary properties. Can you say the same about Bitcoin? Let's assume that you cannot anymore do anything, having to do with the monetary system with Bitcoin. What else can you do with it? Nothing, right? That's why the answer is gold. Now, if Bitcoin catches on, can it have a much better upside potential than gold? Yes, it can. But what we know from the financial markets is that when left to function freely, having a bigger upside potential always comes with having a bigger risk. And since I doubted that there is ever going to be a central bank supporting Bitcoin, meaning buying Bitcoin to keep its value, at certain levels, that means that yes, by owning Bitcoin, you have a bigger upside potential in percentage terms, but you also have a downside potential all the way down to 0.0. So I'm not against somebody having a small part of their portfolio being in digital risk like Bitcoin, Ethereum, or whatever altcoin you believe is a good investment, let's call it. But do I think that you should be converting everything to Bitcoin? I think that's gambling. So that's, you know, a short answer why gold and not Bitcoin. I believe gold has a purpose, but the purpose is destroyed by its physicality. We should separate money from state. 100% of my savings is in Bitcoin and I use it daily, but thank you for explaining your point sincerely. Mate, what I'm telling you is, first of all, I wish you luck, and I mean it, you know, wholeheartedly. But I think you shouldn't be doing that. You know, friendly advice. You might gain and make a lot of money, and you know, I sincerely hope you do so. But putting everything in one basket is always dangerous. So, do I think that the monetary system is going to eventually evolve outside of government controlled money? Yes, I do. Yes, I do. But does that necessarily mean that it's going to be Bitcoin that replaces it? You know, that's a big question. So I think you should be a little bit more differentiated, my personal opinion. But as I said, I wish you all the luck, honestly. Bitcoin is not a flight to safety asset, says Andy. Constantino says, bye, guys. Go to catch another webinar in 5 minutes. Thanks. Bye-bye, Kostas. Any news on Asian Indian market? There was a question about USD INR. I'm going to go fast there. Whoop, mistyped. Okay, here's USD INR testing triangles resistance, as many of the exotic currencies are currently at lows. This is USD INR, right? Not INR USD. So INR is at lows. I think that we're probably going to see a breakout and a move towards 78.50 for our friend that is asking here. And if you mean the Nifty, which is the Indian stock market, I have to say that so far the recovery in the Nifty is very, very underwhelming. So I think it's corrective in nature, and I would probably assume that it would fail anywhere between, you know, yesterday's highs, because yesterday's reversal was, you know, a decent one, and 9,700. So I think there's more pain to come for the Nifty. So I think you should be quite careful. Question about treasuries and the yields. Absolutely. So 10-year yields, here they are. I think that eventually we're going to see in the short to medium term lower yields, but I honestly believe that anybody that is actually buying bonds at current valuations is crazy if they don't have a very short-term horizon. Simply put, you know, sometimes you have to go back to basic economics. What is a bond? A bond is a promise to get paid in X currency in a future date, right? So what is a US Treasury note? It is a promise to pay you back in 10 years in dollars with, currently speaking, a ridiculous annual return of 0.6%. Now, out of curiosity, what do you think the average inflation is going to be during that 10-year period? So bottom line, what I'm trying to say here is that some people that will be holding this bond until it matures are going to make some money by selling it back to the Fed or selling it to somebody else that hopes that they can make some money before they sell it to somebody else, which is basically the definition of a pyramid scheme, right? But by the point in time that the bond matures, on average, people that will have held it cumulatively will have lost money because the real return is negative, right? So there is no question about it. The vast majority of bonds and a huge part of the bond market due to central banks is probably the biggest bubble we've ever seen in the financial history of the world. Now, somebody will say, but, you know, why the hell would you fight the Fed? Why the hell would you fight the BOJ? Why the hell would you fight the European Central Bank, etc.? The answer is because history has proved that even central banks, when things really go bad, lose. We've seen that even with rather recent examples, most recent of which being the Swiss National Bank, which was devoted in holding the Euro-Swiss floor at 120, and they let it go suddenly one day when they realized that it was completely uneconomical trying to support it anymore because it was impossible. They were accumulating euros in a rate that it was unviable. So projecting down in the future, they realized that they can't keep doing that whatsoever. So they let it go. We had the example with the pound, right? And the Bank of England, that was like 30 years ago, but still. So bottom line, the Fed is going to be winning, and any type of Fed, any type of central bank is going to be winning the fight until one day they lose the fight. And when that happens, the type of moves you're going to see when the market tries to reprice a real risk to bonds is going to be something unprecedented. It's going to be something that books will be written about, that people will remember 200 years going forward. Like, I don't know what the name is going to be that they give it. We have like Black Monday and, you name it. We always find, a name for, huge, groundbreaking financial events. But trust me, every other we had in the history is going to be dwarfed by what's going to happen the day that the bond markets are going to break. I can tell you that that's going to be during my lifetime. I mean, it's not going to be, it can't be in 100 years from now, but can it be in 5 years from now? Yeah, it can. So, it's not something you should trade off in the short term with, but keep in mind that in the long term, the bond markets are going to completely break down because they're currently not pricing risk. They're not, in essence, they're like 100% nationalized in some cases, but that can't go on forever. And I'll tell you when that will stop happening. When the cost of supporting them, it's a simple cost benefit analysis. When the cost of supporting them will have surpassed the cost of not. When is that going to happen? When the equivalent currencies are going to be blowing up. So central banks won't be able anymore to keep printing money to support financial markets, because the rate of devaluation of the currencies is going to be such that there's going to be no alternative but to actually increase rates and let the market settle. That's when that's going to happen. And with what's happening at the moment, I project that that's not going to be that far into the future. S&P below 2772. Will that make it bearish on a daily closing basis? Let's have a look at it. 2772. I'd have to say that 2750 is probably a better level to look at as a first area of support. But if you want to, let's go to a 4-hour chart. So you'd rather go to a 4-hour chart. There we go. And the best thing you can do in this case is probably draw a trend line. There you have it. So I think breaking through this trend line is the signal you're looking for. Okay, that's what I think. In the case of DAX, here's the DAX on a 4-hour. You can see that so far this recovery seems to be a pennant, contracting price action while appreciating with obvious lack of momentum. So this looks very heavy to me. I would assume that something like that is going to happen eventually. I mean, we might see a little bit more of a, consolidation, something like that. Pound, question about the pound. So here's the pound, quite a nice daily reversal yesterday, exactly from the 200 daily moving average. So we got rejected from the 200 DMA. We're still holding though these highs. You can see it back there, these highs. So, there is still some chance we can push a little bit higher if we hold this 2450 area towards the 61.8. But I think that below 24.50, I mean, obviously 124.50, I think that we're going to see more weakness. USDMXN. USDMXN is holding up quite nicely. Obviously, some type of a consolidation here might be a bullish consolidation, meaning, as I drew back there, we might need one more high before we fail. So I would be careful here because we've seen some violent swings, but the fact that we're not really breaking down is definitely not a bearish sign. So I do think that USDMXN is likely to produce new highs when stocks are going to be turning lower once again, before finding a low in stocks and probably a very nice high in USDMXN. I think USDMXN after one more high is probably going to be a very nice shorting opportunity. Keep in mind that in that case, you'll also have a very nice carry paying you extra for holding long MXN against the US dollar. Yes, the link is working. Thank you. Okay, yeah. I think you should all register for the event. It's going to be an amazing event, and it's a free event. So, there's no real downside. Your opinion on crude oil market. My opinion on crude oil market is that clearly the downside momentum has waned, but they've clearly not done enough to support the crude market. So I'm still hoping that we might see a lower low. $16.50 is the 127% extension of that last rebound. But I do think that after seeing one more low, crude oil is going to be an amazing buying opportunity. I think it can literally end up doubling in price within 2020. That's what I think about crude. And having to do with natural gas has given back almost all its recent gains, so it has invalidated the breakout from this channel. But also, coming back to what I said about crude, it's clear that it's currently very cheap, and the downside momentum has really, really stalled. I mean, you can see the RSI divergence as well. So I think that there is not a lot more downside left in both of those, crude and natural gas. I think that the next big move is going to be to the upside, but that doesn't mean that we can't see new lows first, right? But I think that the next big move that the market is going to produce whenever it happens is going to be higher and not lower. Joe, oh my God, Joe, you're a real troll. Sir, if you can spare just a moment, please explain. You said Nifty may rally a bit before it falls. Right, yes, but just a bit, because the rebound so far looks corrective in nature and not impulsive. You said exotic currencies should be under pressure. Would this be the same for those currencies, stock markets? Listen, in general, depreciating currencies support stock market prices in general, because keep in mind that in emerging markets, big part of investing is happening from foreigners. So whenever the currency is depreciating, that means that foreigners can buy more stocks by spending the same amount of money, right? I mean, of their own currency, money. So in general, depreciating currency is somewhat supportive for a stock market, but that doesn't mean that when the economy is also moving lower, that you can have at the same time a depreciating currency and a depreciating stock market. So, under periods of real economic stress, those two can and do happen concurrently. Okay. So, for example, the fact that I expect the Indian rupee to weaken a little bit further doesn't mean that Nifty can't at the same time be moving lower as well. It just means that it will be doing better in comparison in what it would be doing if the Indian rupee was strengthening at the same time. That's all. Mark Yusko has all his money in Bitcoin. He has crypto fund though. That's not the case. And I can tell you that because I've actually met Mark Yusko in person. I mean, we've had drinks a few months ago. So I don't think that Mark Yusko would have all his money in Bitcoin whatsoever. Is he a big believer on cryptocurrencies? Yes, he is, undeniably. And you have to keep in mind that he has Morgan Creek Capital and Morgan Creek Digital something, whatever its brands for cryptos. But Mark Yusko has been and remains a fund manager that manages roughly $2 billion not in cryptos, right? So having met Mark, he's a very, very smart guy. And he's yet to convince me that, you know, I should be that bullish on cryptocurrencies, but I do appreciate his point of view a lot. I mean, he's definitely a great guy and definitely a very smart guy, right? He might prove to be right, but trust me, there's no way he has all his money in Bitcoin. No way. And I think nobody should have all their money in anything. I mean, I'm a big believer in gold. Do I have all my money in gold? Absolutely not. Right. They say weekend while Czar weekend. That's why I asked. Thank you very much. Yeah, my pleasure for answering. Dotted RSI line in gold. Dotted RSI line in gold. Let me see. This one. Oh yeah, I use that as an extra indication of a breakout. Sometimes you see when price is breaking out at the same time, RSI is breaking out. You can see it here. It happened there. You see, we had this descending trend line in RSI. Once we broke out from it, we confirmed the breakout there as well. So that's the answer about your question. If time permits, can you please comment on the relationship of futures X Dow during the 12 hours prior to open to the actual day following? Is the high-low range usually similar to the actual day range? You know something, Geoff, I'm not a stock trader. I do trade indices on occasion, but I always trade them through CFDs that trade all day. So, you know, I'm not the kind of guy that goes into such detail having to do with indices because that's not my main instrument. So I'm not the right guy to giving you answers on that. I haven't noticed, sorry. I trade them based on patterns, on technical patterns and fundamental bias. So, for example, currently I'm still long because I believed that central banks would create this fake recovery in stocks, but I'm looking to switch to short once I see a reversal. Because fundamentally, I also believe that the stock market is currently completely decoupled, you know, from the real economy. But you know, if I was purely trading stocks, I would definitely, you know, go into such a deep analysis. But I'm not. Sorry. So I, you know, instead of trying to play the pro in something, you know, I'm not. I'd rather give you an honest answer. Can I ask you why you use 4-hour charts? Is that the bank standards? I use mostly daily charts to begin with. I use daily, weekly, and 4-hour charts. I never go lower than 4-hour charts because I'm not a scalper. I'm more of a swing trader, which on occasion also takes long-term trades. That's how I would characterize my trading style. What do you think about cyclical stock like airlines? I think that if left, they would all go bankrupt at the moment. Unfortunately, they don't let them go bankrupt. And I say unfortunately because there is a big misunderstanding here. Trust me, if they let companies like that go bankrupt, it's not that people wouldn't have airline companies to fly with. It means that the previous administration would go out of the window. There would be new investors coming in, buying the assets of, let's say, an airline company as distress assets at very low prices, restructuring the company to actually be properly managed. And that's how capitalism works. And there is nobody that benefits more for that free market function than consumers. Nobody. So now, having said that, they will be artificially supported. But does this mean that they will be able to overperform other type of stocks? No, they won't. They won't be doing well, is the answer. They would have been doing a lot worse if they let them do what they should be doing. So that's a brief answer. It was late. How is Euro USD? It told me it's good. I'm kidding. It's not doing anything, actually. It's still coiling. You can see swings that are becoming, smaller and smaller. I still favor a little bit more downside. I think that when we see a reversal lower in risk, dollar is going to go bid again, and we might see Euro USD even go to new lows or retest the lows. So I think the next move might be to the downside. But I think that looking at the chart and the recent price action, you should be trading other stuff than the Euro USD. I mean, clearly, this is not something that has a direction at the moment in the market, and you rather choose something that has a much cleaner technical picture. Okay. Hey, Steve, thoughts on copper? Yeah, absolutely. Here's copper. And, you don't need to be an expert to see that probably this type of a rebound that we've seen so far in copper is very likely corrective in nature. Okay, so I have to say that it looks like copper will fail again, and probably it's going to do so when stock indices fail again. In any case, if it continues this rebound, I think that 248 is going to prove to be a formidable area of resistance. So I wouldn't be betting that it can cross through that. DXY is very volatile. Will it break 101 level? Most likely it will. The important question is when. Here it is. I think that when risk goes off again, DXY is going to make another move to the upside, and I think it's going to be rather sooner than later. But I think that after producing one more high, the DXY is going to be going to get completely obliterated. So in the short to medium term, I think it's probably better to be bullish the dollar, but for a very limited period of time, because after that I'm going to turn very, very, very bearish the dollar. How about its fundamentals according to you? Fundamentals of copper, you mean? Listen, copper is definitely a metal that is used in construction. So in general, it is highly correlated to economic activity, and there is no valid reason to believe that economic activity is going to grow in the months, perhaps even years ahead. So I would have to say that the only reason why I would maintain a long-term bullish bias in copper is because it's priced in dollars, and I think that anything that is priced in dollars will eventually do very well. Other than that, I think that copper has no real fundamental reason why it should go next, at least several months. Okay, so it's just what it's going to do against the dollar, which is going to be a dollar function mostly. I've already covered oil that our friend here is asking, so you'll have to go back and have a look at the recording. Let me go through the rest of your questions. Looking for current economic conditions apart from COVID situation, Nifty seems overvalued. What should be the valuation? Can we test previous low? Oh, trust me, there is almost no stock index in the world at the moment that doesn't have potentially more downside if we assess based only on fundamentals, because your question was fundamentals. Now I'm gonna go through that question as well, USD ZAR, and I think we're gonna call it a day. We've already gone 20 minutes past, and then we're gonna see you tomorrow again. Don't forget to register for the Trader Summit. I'm going to put it down again, cover USD-ZAR, and then call it a day. And thank you all for being here. So here's USD-ZAR. This looks to me like a consolidation, likely new highs before lower. Something like this can also happen before that, right? Something like this. So more or less, that's what I would assume. And when will this breakout happen? Probably when you see risk going off again, which I assume it's going to take maximum, a few more days. Okay. Thank you everyone for being here. As I said, register to the Traders Summit. Is going to be an amazing event, and see you all tomorrow.